Hey, welcome back, everybody, to today's Market Explained, a four-star podcast. I'm Brian Castle, your host here, and I have with me my co-host, usual co-host, Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to talk a little bit about the markets today.
So Chris is our Director of Development. He's a master of all things portfolio, building a big team around Chris, a Cleveland boy who loves his Indians. And he's got a burgeoning family of 3 young children under 2 years of age. So congratulations, Chris, and welcome.
Thank you. Thanks, Brian.
And I'm Brian Castle, the founder and CEO of 4-Star. I'm Eagle Scout, trustee of the National Boy Scout Foundation. I'm the husband to the amazing Tripty and chief dad to Quinn and Evan. So that's our story for today. By the way, everybody, if you like what you're hearing, please tell your friends and give us a 5 out of 5 ranking on Apple iTunes. So that really helps us as we get our information out there. So we're going to do a discussion of the markets, the economy, and then other general things that we see out there. A lot of interesting things going on, Chris, with the markets, with some big position changes now. So why don't we go through that with everybody?
Yeah. So like you alluded to, some big changes. We're starting to see some new trends, if you will, starting to come out. So first off, we had a change in the number 1 position. Domestic equities took the number 1 position from international equities, and it gained 27 points from the last podcast. So it's at 266 tally points and has taken that number 1 position. International equities still held pretty firm in that number 2 position. It only gained 2 points though, and it's at 261. So the 1 and 2 spots, international and domestic, are both very close. A bad week by one or a strong week by the other, we could easily see those interchange the 1 and 2 spot. Commodities is in third though, and we saw a little bit of a resurgence in commodities. It gained 27 points from the last podcast, and it's at 215. So it kind of popped back above that 200 mark there. In the third position. The bottom 3 were kind of the losers of the last couple of weeks. Cash is in 4th. It lost 24 points and is at 154. Currencies is in 5th, and it lost 7 points since the last podcast, and is at 103. And then last, I would say probably the biggest loser over the last month has been fixed income. It lost 23 points and is at 90. Under 100 there. So really we saw the top 3, the strong ones, getting stronger. Asset class is getting stronger. And the bottom 3, the bottom asset class is getting weaker. So a lot of trends, a lot of changes. Domestic equities, the number 1 position now. A lot of movement going on.
So Chris, that's pretty interesting information, because fixed income can't catch a break because rates keep rising. So in this environment, you would need variable income, like variable yield bonds, like floating rate bonds. So anyone who has fixed bonds doesn't do as well. So fixed income's taking a beating now for about 18 months, and it continues, doesn't it?
Yeah, I mean, we've seen another strategy of use floating rates or go buy short term. We've seen short-term T-bills, 3-month, 6-month T-bills have been really popular, and they're yielding 4 or 5%. Coming off of the last 15 years of no yield at all, and you show someone they can get 4 or 5% yield off of a 6-month, 3-month T-bill, which is essentially in finance these days a risk-free return, and it's backed by the U.S. government. That's a pretty good deal, and a lot of people are opting for that option.
Right, exactly. And now we're looking at, on the top end, domestic equities, the U.S. stocks are ranked number 1 again. So international has been ranked number 1 for a long time, last 18 months or so, for the most part. So domestic equities obviously have not been good, but now they're back up to number 1. We saw the tech markets move, but now we're seeing a broadening out of the market in the last month or so, right?
Yep. Yeah, I mean, it's interesting. International was running, and it still is strong. By no means has it collapsed. I gained 2 points once again. So it still is strengthening, but I think we're starting to see potentially kind of the top of it. We're starting to get news out of Europe as far as some of the economic news is starting to kind of flatten out. There's talk of potential recessions going on over there. And I think the other big news has been the Chinese market. The economy hasn't recovered quite like people were expecting. So there's been some stories, some hope originally that I think is starting to kind of fade now. Doesn't mean it could reverse, but I think it's starting to slow a little bit.
Yeah, and then the commodities, which were ranked number one for part of last year as well, they're back up to 3. They faded. Now they're coming back up. But that was mostly oil, right, Chris? Oil?
Yeah, so big oil move. We had OPEC, I think, did some production cuts, which certainly obviously impacts the price of oil. So oil's been the big mover, I would say, for right now. We are in the summer months. A lot of people are driving. You got a lot of jet fuel, a lot of flying, a lot of traveling. That's certainly been one of the on-demand industries as of late. A lot of people flying to Europe, things like that. So oil's the big mover. And then, I think the other thing is, even though it's been going on longer now and it's kind of stalemated out to a degree, you still have the war in Ukraine going on. And recently, Russia pulled out of the truce between Ukraine and the world to help get wheat supplies out of the Ukrainian ports. And there was some bombing there. So that's causing volatility in other commodities, both to the upside and to the downside.
So oil, this strong, precious metals is held up there pretty well. But grains and soybean getting hit now a little bit more, right?
Correct, yeah. It really depends on the week, if you will. I think if you go back 2 or 3 weeks ago, grains and soybeans and things like that were exploding. And then now they've cooled off and pulled off of harvest news, things like that. So we're still seeing probably better or bigger than expected volatility out of agricultural stocks, mostly stemming from the Ukrainian war and some of the volatility there. And then the precious metals has been another staple. I would say that's mostly just because we have these rate impacts. We have strengthening currencies, things like that, that are happening. So usually when you have movement like that, you go starting to move in one direction or the other.
Yes. Now, the interesting thing is 81% of companies so far in this earnings season have beaten their earnings estimates. So, it seems like the companies are pretty good at managing expectations on earnings. So they'll probably lower estimates here in August as we go into the end of September. That way they can beat those numbers, in October when they announce the September earnings. So they kind of play with it, don't they? They kind of lower expectations in a strong market so it doesn't hurt their stock that bad.
Yeah. I mean, I think in many ways, the CEOs and the officers of these companies, they're not only do they run the companies, but they're also the best ambassadors and diplomats, right? So they want to put the best look they can on the companies, and they want to try to save as much face, if you will, and save as much of the stock price as they can. So they're going to try to adjust those to make sure they're realistic numbers they can beat.
Exactly. Now, back on oil prices are staying high, although the shipping stocks are getting nervous that oil shipments from Russia are down to some of the lowest levels since January. And the Saudis are storing a lot of their oil on ships. Refiners are making a lot of money. It's a good sign for oil, but it's kind of an interesting situation going on right now. And then because inflation has been easing a little bit, wage increases have now gone above inflation, which means there's real gains. For the first time, there's real gains in income, in net of inflation, because for the last 18 months or so, we've seen investors lose ground because of inflation. Now we're gaining a little bit of that back, which is nice.
Yeah. And then I think that's been one of the highlights, if you will, of the economy being a little bit stronger than expected is the consumers held up, at least so far.
So then we're talking a little bit about our debt levels being really high and people being concerned about our currency. And now there comes another currency that's being issued, the BRICS currency, which will be a group of Brazil, Russia, India, China, and that's going to be issued. So people in these other countries, companies want to trade in different currencies, not just the U.S. currency. And part of that is political because there's a war there's a proxy war between China and the U.S. through Ukraine. So Russia and China are aligned against us, and Russia and China are very influential in certain areas in Africa and Middle East and such. So they're saying they don't want to trade in dollars. So as long as the dollar is the reserve currency, then obviously that's good for America. But there could be some challenge here, Chris, now from this BRIC currency, and that can affect the economics quite a bit because of the flow of capital.
Yeah, I mean, I think, what awoke this to a degree is, when Russia invaded Ukraine, I think globally, for the most part, that was obviously condemned. And the U.S., shutting them out of SWIFT, things like that, certain countries like India, which have been relatively indifferent, obviously China, as you alluded to, and even Brazil, some of these countries that kind of look at it like this isn't our fight, I think that kind of scared them a little bit and saying, well, if we do anything to step out of line, how quickly the U.S. can essentially just cut them off from the world. So we're seeing more of an aggressive push to adopt other currencies. We've talked in the past about the petrodollar. Now we're seeing oil be transacted in yuan, things like that. So we're definitely seeing a slight movement away from the dollar. I think overall, we to some degree saw this coming. I think we talked about it in previous podcasts more about the fear of the debt that the U.S. does currently carry and the risks associated with that. Would the world, be willing to bear that? So it's going to be interesting. I don't think it's going to be too surprising to see, as we talked about, like a basket of stocks become the reserve currency instead of just the U.S. dollar, whatever it is, 10, 20 years down the road.
It could be. Well, and America still has the strongest economy in the world, and that's really the key to it. Obviously, the currency flows help, but the key is that we keep our economy strong. So, I was reading some commentary about where we are as far as fiat currencies, Chris, and I think maybe our listeners might not be aware of all this. All currencies used to be tied to something, gold, and then there was petrodollars and other asset-backed, currencies. And, when we went off the gold standard in 1969, it was actually intended to be temporary. But then a number of things happened, and then Germany decided not to go back on the gold standard. And then all this kind of pushed our hand, and all of a sudden we never got back on the gold standard. So now all the currencies are fiat currencies that aren't necessarily backed by anything. And so it's backed by, how much currency is out there, how much currency is demanded, whether the country's economy is strong or not. But you can't say, hey, I can cash in my dollar and get a certain little mini ounce of gold or minute millimeter of gold of some measurement. It used to be, there were dollars called the silver certificates back in the 1930s during the war, and you could actually cash your dollars in for some small measurement of silver. So, but now all that's gone, and so we have what we call fiat currencies, and so that's really a big issue for America as our debt levels rise, and it's getting a little bit scary. And so now with these other currencies competing, that creates more issues for America and our currency. So it's something we really need to watch as a country, is to stop adding debt. And so there's lots of alarm about that right now. So we'll see. Could be a serious threat to America for sure.
Mm-hmm. Yeah, I mean, the gold, going back to kind of even, pinning the dollar, if you will, with the gold, there's pros and cons to it. I think some of the cons get lost. It's why don't we just switch back to the gold standard? When you are on the gold standard, you have to have enough gold to cover, obviously, if you were able to go and exchange your dollars or how much, or whatever the conversion is to gold. If you go back to the end of World War One, that was issues with Great Britain and even Germany, is the fact that the U.S. had all the gold and they needed to try to rebuild their economies, and they couldn't expand their economies without devaluing their currency, essentially saying we only have so much gold, so now 1 pound in this case is worth less gold than it used to be. So
right.
There's interesting dynamics, I would say, with that gold standard conversation.
Well, that's all part of the issue, and we can get into that even more further. Chris, turning to the economy, the manufacturing ISM is down the eighth month in a row, but it was slightly higher than the June report, but still under 50, which means it's still contracting. And out of the 18 industries tracked in that ISM, manufacturing, only oil industry and furniture were up. So, we're still seeing kind of correcting in the economy while we're seeing strength in the markets. We saw markets hitting near new highs here recently in the last couple of weeks. So, of course, now we're down today, Chris, and that has to do with the rating, right? You want to talk a little bit about that?
Yeah, so last night or late in the day yesterday, Fitch came out and downgraded the U.S. debt from AAA to, I believe, AA plus or AA plus plus. And so it's not the first one that's done it. Moody's already done this before as well. But, whenever that happens, it's obviously kind of a shock to the system, if you will. We usually see a quick reaction within the markets, which is what we're seeing today. Materially, I don't think it has too much of an impact. I think, what they're downgrading the U.S. on has already been a known commodity risk. I believe it's already baked into the markets, and, them downgrading is really kind of a lag effect. I don't know why they did it at this certain time, but I think it's for the most part a non-factor. I think on the markets, I think what we're going to see in the short term, though, is a lot of volatility based on it. So it might take a week or two for the economy or for the markets to digest it, get it out of their system. But we'll see kind of what maybe it leads to more. But overall, kind of from the new information wise, it really doesn't bring anything new to the table.
Right. Well, and frankly, the other agencies went to AA for the U.S. debt in 2011. Mm-hmm. And that was a wild summer in the summer of 2011. But Fitch never lowered to AAA. So they're 12 years later. So you're right. It probably doesn't have that much of an impact, I would say. Interesting. But at least Fitch did it. So talked about the currency, gold standard. Chris, in the economy, overall inflation, it went down to 3% in a recent release, but the core inflation is still 4.8%. The Fed said this week, they raised this past week, and they said they're going to expect it to raise again in September. Even Austin Goolsbee mentioned that again the other day. So we're continuing to see tightening. We're continuing to see a reasonably strong earnings, and they'll manage those earning expectations going forward. But there may be enough earnings revisions downward or expectations, estimates coming down, that could maybe affect the market as well. We're priced kind of for perfection right now with everything moving up. And, so inflation is still a bugaboo. It's still out there. The Treasury bond went back up to highest levels near 5%. And there's going to be some big auctions over the next couple of weeks. And we'll see how the auctions do, because we have more and more debt now that's rolling over every time. And we have to make sure that firms are willing to pay pay for that debt, obviously, and we have to pay for it, I should say, but they're willing to assume that debt. So those are issues that we really need to watch. When a country has lots of debt, they need to be able to roll that debt into new debt, right? When it comes due or matures, unless they want to pay it off, of course. Then that would increase the amount of currency out there. They would have to print dollars to pay off that debt unless they had them. So those are really big issues to watch, and we're going to be watching that closely. But Chris, you had a bunch of other economic numbers. Why don't we go through those too?
Yeah. So just to highlight, like you mentioned, Brian, this past week we had the Federal Reserve raise the benchmark rate to band between 5.25%, 5.25%, and 5.5%, which is the highest level in 22 years. So we've certainly seen that really creep up heavily. A couple of big things I think that are impacting and kind of driving this economy really is retail sales. They rose a seasonally adjusted 0.2% in June, month over month. That's June from May. It's slower than previous months, but it's still a sign that, Americans are still keeping up with, spending, even with the inflation, everything. As inflation comes down, and as you alluded to, Brian, the inflation adjusted average hourly wages, which are starting to now outpace the inflation. Potentially we see that pick up again. But as long as we see those retail sales, the consumer out there, the American consumer spending, that's overall a good sign. So we'll see if that does continue. The other big key with this market is the housing market. So the S&P CoreLogic Case-Shiller National Home Price Index, which is just a fancy index of saying that the average price of a home, it fell 0.5% in May, year over year. So from May of 2022 to May of 2023. So we're starting to see home prices decrease, albeit things slower than some people are expecting. And a lot of that is due to the supply and demand issues in the current housing market. Existing home sales is a good proof of that. They decreased 3.3% in June from May. So that's just month over month, they decreased 3.3%. So we have a real a gap there really in supply and demand of housing, especially on existing homes. You know, a lot of people who are in current housing and they don't want to leave. They don't want to subject themselves to 7-8% mortgages when they're locked in at 2 or 3% mortgages. So you really have no supply on that end, and you have a lot of demand. A lot of people want to go buy a house. They're waiting for prices to come down so they can go buy a house. So what's ultimately going to be the big driver of that is if interest rates start to come down, or the big other thing going on has been builders. So once builders continue to build and get that supply up, so those people can go buy those new homes instead of existing homes, that will see some of that pressure come on as well. So it'll be really interesting to see how this plays out. I think a lot of people weren't expecting the house prices to stay as inflated, if you will, as they have been. So it'll be interesting to see how long that stays.
So that's an aggregate number, Chris, national number. Yet the strongest stocks we've had in our portfolios have been the building stocks. So they're still building in the what I would call the economically attractive states, where taxes are low and economic activity is high, where people are moving. Florida, Texas, Arizona, Nevada, those states where people want to move. So we're still seeing a lot of building, but yet in aggregate, there's enough of a kind of a air pocket that the market hit because of interest rates that we're seeing the numbers start to fade in pricing. It was around this time last year, Chris, where home prices were on a tear, just wouldn't go down, kept moving up, hitting new highs. So it was between like June and August last year where the real estate market started to slow down. We're seeing that continue here then, right?
Exactly. Last year we saw, because it was the beginning of that rate hike cycle, so we saw kind of a race, if you will, to try to beat the higher interest rates. So we saw a lot of people competing for a limited inventory housing or much greater demand for pretty much the same supply. Whereas now we're kind of seeing the aftermath of it and things are starting to kind of slow down. They've been slowing down certainly on the sales side. Now we're starting to see prices start to kind of creep down a little bit.
Yeah.
And then on the international front, a couple things I'll mention, the Mexican peso reached its strongest level since 2015 and is actually been the best performing fiat currency on the past year. So it kind of went a little unnoticed if you aren't kind of in the finance or currencies kind of world. But Mexico actually just recently raised its benchmark interest rate to a record 11.25 or 11.25%. And that is from just 4% in June of 2021. So we've really seen a big move in the Mexican peso. You know, overall, that's good for the Americans. I mean, for America, because if there's a strong peso and a weaker dollar, we're going to see more people buying, imported goods from Mexico, things like that. It's when we have the strong dollar, it's cheaper to go to Mexico. So we're seeing a lot of kind of play there. I know the big trend's been the dollar versus the euro. We've seen a lot of people wanting to go over to Europe because it's cheaper now.
Yeah.
And then the last thing I'll mention from the international front is China came out a couple of weeks ago and said they're targeting a domestic stimulus plan to boost domestic demand. So a lot of the economic numbers coming out of China have been pretty morbid. They've been either in recession or pretty much nearing recession, if not already there. Then after that fact, China's manufacturing purchasing managers index numbers came out and they fell to 49.2 in July from 50.5 in June. And anything below 50 is contracting. So that's just another bad number. And I think it's interesting because If you go back 4 or 5 months, there was a lot of optimism coming out of China that we were going to see this big resurgence. We saw that driving a lot of the commodities market, and you're just slowly really seeing that drained out of the markets right now. So it's going to be interesting to see how that plays out. And obviously, China's going to do something to try to avoid that. We'll see how big their stimulus plan is, if it has any material impact.
Well, and all those stimulus programs, very seldom have any real net gains over time. They may pump into the economy money, and then for that really to be effective, there needs to be a multiplier effect where $1 equals $3 over time, but it usually never works that way because of the inefficiency of these stimulus programs. So, but of course, at China is a government-driven society, so they think the government can do everything. But all the stimulus programs in America have never panned out, and they don't really plan out in China either, but that's still how they do it because that's what they think they need to do. We've not seen any real negative numbers out of China, and we learned recently about how they do their calculation on GDP, where all the numbers come in from the local areas, so they have to go higher and higher through the Chinese Communist Party, so everyone wants to make their numbers look good. So we never see negative numbers now, but Chris, the numbers you're saying, if there is a negative manufacturing number that they had to release, how can they possibly be having, positive numbers in the economy if they keep showing negative numbers and they have to do a stimulus? That means things are slow. So why are the numbers always positive? It doesn't make a lot of sense, right?
No, it doesn't. And I think, when you see numbers like this coming out of a country that is heavily regulated and controlled by the government, I think a lot of people, A, take numbers that are given there with a grain of salt, and B, that just points to the fact that things are probably a lot worse than even this mild recession, would point out. So what that would say is they might already be in a heavy recession.
Yeah, it appears to be. It appears to be. And now America's doing onshoring, where we're pulling a lot of the manufacturing out of places like China, moving it to either America or to places like India, where it's more politically favorable to American manufacturers. So that's, I'm sure, got to be affecting China as well.
Mm-hmm. Yep.
So anything else on the economy, Chris?
That's it.
Okay, good. Well, let's talk about the banking crisis. The four major banks, JP Morgan, Bank of America, Citigroup, and Wells Fargo, four biggest banks by assets, gave up a net $262 billion in deposits when compared year over year earlier for this most recent quarter. From the first quarter to the second quarter, customers pulled out $62 billion from three of those banks. So meanwhile, we saw a run on the regional banks earlier this year. We saw a couple regional or smaller banks go under. Now regional banks have started to gain deposits. So the investors are rewarding them for that and setting their stocks higher over the last 2 weeks or so. So we're seeing a big spike upward in regional banking stocks after them getting hit really badly for quite a while. The positive divergence reverses that trend that took hold during the chaotic scramble for safety following the failures of Silicon Valley Bank and Signature Bank and then First Republic out on the East Coast. So those seizures led to really crippling withdrawals a number of regional banks during the first quarter, but now that's starting to shift a little bit. So that's a positive for the regional banks, a negative for the large banks. When interest rates are high or higher and banks don't pay that much in their deposits, well, then people are going to pull money out of the banks and put it into an institutional money market fund, or Vanguard's got a 4%, Charles Schwab's got a 5%, Raymond James through Fidelity has a 5%. So there's some better yields in there and what are considered to be riskless investments in money markets. They're not completely riskless, but that's what people think. There are some risks to money market fund, but it's certainly on the scale of risk, it's a lower risk. Let's put it that way. So that continues to be an issue. So when interest rates finally do ease, that'll leave less pressure on the banks. But for now, it's still kind of a tough time for the banks because they can't really pay 5% on deposits yet. That's where money market yields and the short-term Fed rates are. So,
yeah, a lot of pressure there. I mean, and I think the big key there is we're seeing that impact the small community banks and middle market banks. definitely more that's going to impact like the JP Morgans, the Wells Fargo's, the big banks. Is it going to have an impact on their balance sheet? Yes. But is there any risk of them going under per se? No, not at all. So, I mean,
Probably not.
There's never none, but it's very low.
Well, and just by way of reminder, folks, that we did see the same kind of activity back in the banking crisis of the early 1980s when interest rates went to record levels higher than we've ever seen. I remember getting a 20% money market in 1980. So we did see a lot of banks go under. In fact, the savings loan industry, because it was a little bit unregulated, got to the point that the entire savings loan industry was dissolved, literally hundreds and hundreds of banks, and they became part of the regular banking system, FDIC. So when interest rates rise, a lot of players involved in money flow, for whatever reason, are not prepared for it. And so then we see things break, we see banks collapse, we see other things break, currencies break, people with too much debt get exposed. And so that's the same kind of stuff we've been seeing here. I'd say on measure, though, this has been more mild compared to what went on in 1979 to 1982. But nonetheless, it's still happening to some extent, Chris. So,
yep.
And then what we see out there, you've got a couple of choice comments there, Chris, if I remember right.
Yeah. So just a couple of interesting updates. So UPS just avoided a strike on a planned 5-year deal. So that was good. There was some worry about that. But interesting, the trucking company Yellow, there was a strike from their kind of Teamsters, if you will, and they just filed for bankruptcy towards the end of July. And that's a big hit. Yellow was actually the cheapest, usually, trucking company operator. So Walmart used them a lot of low-cost budget carriers there. So we could see this eventually, since they did file for bankruptcy. They are doing liquidation. So they're no longer going to be essentially a player in that space. We could see this impact the cost of goods on stores such as Walmart, as maybe freight costs go up slightly. So that'll be interesting to see how that plays out. And then the last thing, interesting, an old one, GE is starting to actually kind of finally move again after being, for the most part, dead for the last decade. They've just lifted their 2023 profit forecast. And this is actually a forecast after more robust earnings and demand from their jet engines in parts. So this kind of goes back to the fact that we're talking about. We're seeing a heavy boom in leisure and travel. A lot of people traveling to Europe. We're just seeing the airline industry continue to see a boom.
Yeah, no, it's a lot of interesting things happening. The Yellow bankruptcy, maybe it's negotiation because they have 30,000 employees. Hopefully they don't have to release 30,000 employees, but if they did, that would be very catastrophic. We'll see if they follow through with the bankruptcy and the liquidation. We'll see if that happens. From the page of the book, that being honorable, at least Morgan Stanley recently admitted they were wrong in March when they said they were looking for a vicious collapse in the stock market that never happened. And, that's one of the reasons why, Chris, we don't do predictions, because you're often wrong. And, why predict things? We just try to follow trends and understand what's going on. And if nothing's working, we try to be in cash and cash equivalents, so we don't do any damage. So that's what happens when people make predictions. But at least Morgan Stanley admitted it. But Morgan Stanley, the big firm, is now also getting back into the ETF business. They just issued 6 new exchange-traded funds, and they were one of the originals in the exchange-traded fund business and got out of the business, so they're getting back in. So anyway, kudos to Morgan Stanley for at least being honest about what happened. And lastly, Chris, I just wanted to close with, there's a Gallup poll that a lot of Americans are losing faith in a 4-year college education. We've seen a lot of really stressful situations in the college world. Starting with the Clinton administration, they started offering liberal loans to people for going to college, any kind of degree, and so many of the degrees were not degrees that could pay back $100,000 in loans. The lowest measurement ever, only 36% of college students are confident in a college education, down from 57% only in 2015. So the same period, very little confidence number, from 22% up to 22% from 9%. So very little confidence in a college education. So every group showed declines. Notable, most people who identify on the conservative side are way down to 19% from 56%. So a lot of people are losing faith in college education. So we need to kind of re-up why we get a college education. What's the value of it? Are we spending too much on it? We need to kind of get all that stuff back in line, I think. And if people are losing confidence and they're not going to colleges, maybe college prices will start to come down. That was one commodity that for a couple decades saw nothing but increases in pricing. And a lot of it had to do with the increases in salaries for the professors. Some of that's now coming down. We're seeing some colleges close or merge with others because they can't get the funding anymore. But I think we made a bunch of mistakes in that whole segment where the government was controlling everything with regard to colleges. So let's hope we get that back in line. So that's all we had, man. I've got a couple of blog posts on the leadership matrix. We put one out, interestingly enough, about all the travel wars that are going on. And the travel wars, with so many people traveling, kind of a pandemic effect, and also just people wanting to get out of their houses. A lot of people haven't traveled much the last couple of years, so we're seeing a huge boom. And there's a lounge wars now that all these companies are getting into the travel lounges, go to the airport, with the leader of a community bank. So we're gonna get an update from one of the local community banks in Chicago, who's doing very, very well, and that's First Eagle Bank. Mr. Andy Salk is the owner of that bank. So anyway, I think that's all we have for today, Chris, right?
Yep, that's about it.
All right. Well, thanks, everybody. It's August 2nd as we tape this, and we wish everybody a great August. It's a great time to spend with family, and it's warm out, and the beach is nice. So everybody have a great August, and we'll be talking to you later in the month.